good afternoon. You're tuned into Closing Trades on 80 now. I'm Anisha Jain, with me Saisha Faridi. And for now, the market has cooled off a bit from the highs of the trading session. We're still in the green, so no worries around that. But it's just a bit of softness, and as we speak, actually, we have turned into the red. So off the highest point of the trading session, and that's been the nature of the market. The selling pressure that comes into picture as soon as we see a bit of a spike that has played out yet again today, and there's a bit of a pressure on the screen. The banking index was as it is underperforming, and that too has taken a turn for the worse. Let's pull up the broader indices. Yes, there is a bit of a sell-off there, as well as far as the mid-cap and the small-cap indices are concerned. Not by a whole lot. We're still 120 points down on those indices. But the fact of the matter is that the volatility is something that has remained the biggest talking point, and India VIX continues to surge. So last time I checked, it was just between that 18 to 19 mark. Right now is just below that 18 level. So that's something to watch out for. Just ahead of the union budget, of course, one can expect more volatility. But the big question is, Asha, whether we'll see that kind of volatility on the budget day that we saw last year, when there was those very wild moves and swings that we saw on an intraday basis.
Doubt so that we would have those kind of volumes to bring in that kind of volatility, it being a Saturday and an elongated week. And I don't think the market is going into the budget especially with any high or heightened expectations. It's really been all about earnings and the kind of FI outflow that we've seen, the kind of falling on its own weight kind of scenario that we've been seeing playing with the market right now. So yeah, flat right now for the index. KPIT, Laurus Labs, SRF, Berger Paints, these are your standout outperformers, or for that matter, even SRF. But I unfortunately can't say the same about a Voltas, or for that matter, even a Tata Motors. Look at how the street has actually, slammed the Tata Motors numbers. Nuvama has come out with a reduced. The earlier target price was 750 on Tata Motors. They've reduced it to 720, and it's even more stark when it comes to Jefferies, wherein it's an underperform rating. They've downgraded the stock now from an earlier buy. The target price earlier was 930. It's all the way reduced to 660, and we've already breached that 700 level on the stock price today. Haven't seen much of a resurrection. Whirlpool is the other one, in case you're wondering why it's down about 20%. Whirlpool Corp, that's the parent company, is going to be reducing its ownership to 20% by mid-2025 or late, and that's why you're seeing that bit of a cool off on the stock. Laurus Labs, the US humanitarian waiver is auguring well for HIV treatment. US is saying that they're going to keep funding life-saving HIV treatment. The waiver is now going to allow access to treatment in about 55 countries, much unlike the scare that we had just a few days back when you did see a big correction also play out on Laurus Labs. But here's what the management had to say about this waiver.
Amount of money spent on purchase of drugs to treat HIV is about $1.5 billion. And all agencies and governments spend 10% of their money on the purchase of drugs. That is to treat little over 25 million patients. If the funding is reduced, it's very obvious to expect they will continue to buy the medicines, because they are only spending 10% of their money on purchase of drugs. Because all the agencies, governments achieved significant progress in containing this disease, so they will continue to buy medicines. What may suffer is educational programs, frequent testing. The WHO and Global Fund or UN desire to go 95, 95, 95. That may not be achieved. That means new patients may not be enrolled, but we expect existing patients will continue to receive their medications. And second, countries like South Africa, India, Brazil, Thailand, China, most of the HIV drugs are funded by their own government ways and means. They are not depending much on the global fund or FAPA. About
slabs. But not just that, in the trading session today, Kirloskar Brothers in the last few minutes has perked up. Max Health numbers just came through and looks like it's getting a thumbs up from the street because Max Healthcare too is doing well in the last few minutes. It's managed to see a bit of a perk up. And talking about other pharma names or the healthcare names, Dr. Lal Path Labs is up. AstraZeneca is seeing a bit of a perk up. So some of these pharma names are seeing a bit of a bounce back despite the market tumbling away. We also have our chartist as well as Sandeep Sabharwal on the show, but let me first take it across to Kunal to get a sense on the markets as well. Kunal, this sell-on rally kind of texture, is it likely to continue?
Yeah, I think of course it's likely to continue for some more time because it still looks like the selling from the FI, at least on the cash side, is still not out. Although I think on the derivative side, we've seen quite strong evidence that they've started to go into a short covering mode, especially on the index futures. Then there could be multiple reasons for that: the expiry, the increasing lot size, etc. So I think we need to see whether this pattern continues for the indices at the start of a fresh series. However, I think the markets would also probably want to go light, at least in terms of the leveraged or the FNO positions going into the budget event, because we've seen heightened volatility generally on the budget day. So I think on the back of this, you might probably expect the markets to be volatile. But what we are also seeing today is the index still giving an indication that we are continuing to trade into a range. So there was 2 days where the index fell below the 23,000 mark. We closed below those levels, but then I think more or less 23,000, 23,500 should act as a range, at least till tomorrow, pre-budget day.
Okay, counting down to the budget. Sandeep, hi, afternoon. We've already seen about close to $10 billion of FPI outflow. What can the budget really do to get the foreign money back into Indian equities?
Foreign money outflow is a combination of two things. One, the global outlook, where the overall dollar index has been rallying. The US risk-free itself is giving you 4.5%. So I think from the emerging market standpoint, the threshold of returns becomes that much higher. And I think that's been one reason why most emerging markets have in general suffered. But India is specifically stood out because of such huge outflows, because of various reasons, which include taxation changes, the slowdown in growth which we have seen, and earlier high valuations. So the valuation obviously have corrected. I think on the large cap side, I don't think the valuations are excessive at all. The results have been pretty decent from a majority of the large caps, and a lot of mid and small cap companies. Like some have done well, some have not done well. But for foreign investor flows to reverse, one, the global phenomenon, the global US dollar rally has to stall, which is possible because the US dollar longs are one of the highest in the last several years. And secondly, Indian growth has to revive. So what the budget can do is to put out significant, like measurable measures, sort of, for the revival of the economy, which could include tax cuts, which could include continued capital expenditure. And there are various things they can do. They can tinker with taxation, they can reverse the increase in capital gain taxation. So I don't expect any of these things actually. But then these are things they can actually do to revive the economy.
Let's see what they actually deliver, and is it even fair to keep those expectations, because we have been disappointed earlier. But Naresh, is there any trade that one can attempt ahead of the budget, or is it just better to stay out of the market, and maybe once you get the clarity after the event, that is when you start to take positions again?
This is one of the few budgets where we are not seeing a lot of discussion happen on the railway themes or fertilizers or even price action. So that tells you there is no pre-built up as such. So post-event would be better, because if there is something positive, one should be able to trade on the day of the budget or the next day onwards. So I would wait it out and wait for the budget to be out.
Okay, hold on to that thought. We've fallen a good 0.6% from the day's highs. Tata Motors, Voltas, CAMS, ABB, they're all getting cracking in a trade and haven't seen any resurrection, at least Tata Motors and Voltas, from where they began off in trade. We'll take a very quick break, come right back, we'll continue analyzing markets. But for closing trades right here in ET now, the market, of course, is getting wobbly because once again, from that dip, you're seeing a slight bit of recovery. Let's see how long that sustains. Expiry day, so be sure it's going to come in with its fair share of jagged edges. Laurus Labs is holding out quite okay. KPIT Technologies up 5.5%. SRF, Granules, Berger Paints. These are some of your other winners in trade. But Sandeep, just wanted to understand, anything from the earnings so far that stood out for you and anything earnings based that you may have taken a trade on?
Not so much earning based because at this stage, because the budget is a bigger event than the earnings in the immediate term. But I think we've seen very good earnings from some companies, and so I think it's been a mixed bag actually in terms of earnings, and a lot of the mid and small caps are yet to report. But on the large cap side, I was enthused by the numbers of obviously ICICI numbers were very good, Reliance numbers and outlook seem decent, and both Bajaj Auto and Maruti numbers seem pretty okay. And the good part is that their guidance of growth seems to be positive, especially the kind of export numbers these companies are showing. So although domestic growth is subdued, but they are doing so well in exports that that will help them. And the stocks have also corrected significantly, especially Bajaj Auto. So I think Bajaj Auto is something which we lately added on the large cap side.
What about M&M and Tata Motors, and especially after the commentary, Sandeep, coming in from Tata Motors, talking about concerns around, JLR volumes abroad?
Tata Motors, after the big fall, seems cheap now because most of the analysts have now turned negative, and we are seeing the bad numbers have already got reflected. Now it's a question of waiting for the stock to bottom out. So I think, in my view, it is already in value zone. I'm not buying it right now, but at some stage, it it could obviously be something which can be bought because it's fallen from almost 1200 to 700 now.
Motors looking cheap now, though there was a bit of an earnings disappointment. But just looking at the stocks which are reacting, and news at the bottom of the screen wherein SRF con call is underway, and they're talking about how Q4 is likely to be better on both in terms of sequential as well as the year-on-year growth. They don't have much plans to expand the R32 capacity for the HFC gases, but exports is something which is going to be strong for Q4, especially in the refrigerant segment. We have been hearing and seeing reports around how the refrigerant prices have spiked because of that supply demand gap, and that might just work out well for SRF. The earnings were also quite decent, and now the stock is reacting as the commentary from the management on the con call is also optimistic. But Naresh, within this entire chemicals basket and the fact that we are expecting UPL's earnings soon, is there a trade or any stock within the chemicals basket that you would recommend as a buy?
So UPL looks very interesting for two reasons. One, the whole sector has gone through a phase of consolidation. UPL has gone sideways now for almost 8-9 years. The stock was 500 first time back in 2017, and the stock has gone nowhere in that period. In the short term, in the last 1 year, the stock has made earlier a base at 460, a recent base now at 500. Today, it has given a breakout above the last 3-month range. So after a long time showing relative outperformance, the bigger trend starts once it crosses 600, 620. So UPL, where the risk reward looks the most interesting on the whole chemical space.
Okay, point taken. So that's the view coming in as far as chemical companies are concerned. But L&T will come out with its earnings later today. We'll go across Urea shortly to get the expectations. But before that, Sandeep, this entire capex expectation which is lined up from the budget, of course, FY25 has been dismal in the sense that they're going to miss the target by at least 15 to 20%. Do you think that would mean that there could be a big recoil in FY26 and that could be a year of big capex announcements and projects coming to some of these infrastructure companies?
The project awards have got delayed significantly, and many companies have reported low order accretion. So even if they start placing orders, it will take some time. But then government capex has to pick up. The reasons for why it got stalled so much is still very unclear. and why the government has just gone into a shell and not spending. So the key is how what they forecast for next year, because if they forecast because the base itself becomes lower. So if they forecast a 15-20% increase in capital expenditure budget, then I think it should be taken positively.
We're talking about L&T. Let me take it across to Ria as well and find out what the market poll is anticipating in terms of what the earnings could be. Ria?
Let's take a look at what the street is penciling in for this quarter for L&T. Quite a good set of numbers is expected. The revenue is expected to go up by around 17% on a year-on-year basis, and the EBITDA will also see an increase of around 18%. Net profit is expected to see a surge of around 28%. Coming to the margins, we're expecting a gradual increase in the core margins. For EBITDA margins, they will remain largely flat in this quarter at around 10.4%, and the net profit margin is expected to see a marginal increase to 5.82% in this quarter. We're also expecting execution growth to pick up in the core construction business, and the company will also continue benefiting from international spending and a potential revival in domestic spending as well. Now, as you said, a large order inflow is also likely in the second half of this year, specifically in the Middle East and across India as well. Some key monitorables to keep your eye out on as well: the domestic order pipeline, a margin performance and working capital cycle, and also lastly keep your eye out on a potential execution ramp up in the Saudi projects and the trend in the GCC order pipeline as well.
Okay, point taken. We'll watch out for L&T and all of those data points when the earnings are out. In the last few minutes, Welspun India and Vedant Fashions, both of these have taken a bit of a knock. Let's just pull up some of these names and see what's exactly happening, because textile as a space was actually picking up, but looks like with the market tumble that we have seen, some of these stocks have also come under pressure. Nuresh, any view on the charts of these two names?
So Welspun Living is something which looks interesting. The stock has corrected quite a bit in the near term. Earlier, the stock was in a strong uptrend. So for now, watching for it, say closer to 130-35 mark would be a good entry point.
Textile stocks like Welspun Living as well as Vedant Fashions under pressure. On the gaining side, Sirma SGS is doing well. Adani Ports is seeing a bit of a result reaction. I think they've upgraded their margin guidance for the year, and that's worked out well for them. How is the new age tech universe performing in terms of the Zomatos and Paytms of the world? Because yesterday some of these stocks were fairly active. Today they are quiet in the trading session. But IT as a pack is seeing a bit of a reversal today. Yesterday these stocks were fairly excited and real estate is bouncing back. Kunal, on real estate, what's the view? Because the street is divided there. Some believe that it's time to take some profits off the table because they've done rather well for the last couple of years, though in the last 1 month it's corrected, while others believe that there's still a long cycle to go. What's your view on real estate?
I would believe that there should be more correction for the real estate stocks, and may not be a best buying territory from a longer term play, because many of the stocks, for example, have just gone sideways over the last many months. So, when you compare this with the kind of uptrend these stocks had shown mid part of 2024, for example, stocks like DLF moved from 750 to almost 950,000 levels, and from 1000 the stock has come back to that 750 mark. So it's just about gone through a time wise correction when you look at this over the last 12 months or so for DLF. But then I think the major part of the price correction could probably start off once these stocks break below their critical moving averages, or even the the weekly and the monthly chart support. So I believe that phase is yet to come, because we've typically seen the real estate sector to be more high beta in the market corrections, in the previous market corrections many a times. And I think if that's the case, then we could probably expect that the sector overall could correct further.
What is your own sense? Because the sector definitely has had its time in the sun ever since those COVID lows. Last year specifically was great for real estate stocks. But as one sees, so far the quarterly numbers are at best mixed. Do you think it's time to profit take perhaps? Or not? If there is a further decline, should one add to positions?
The real estate sector has been an outlier to the overall, I think, capex, infra, demand scenario in the economy theme. But I think lately what's been happening is that on ground sales of units have been coming off, inventories have been rising, although the reported number of companies still continue to be encouraging. So I think 2025 could be tough for many of the real estate companies. and many of them have rallied significantly. So I would think that this is one sector which we can avoid at least for this year.
Real estate might not be the shining star in 2025. There might be better opportunities available. But would you take the opportunity, Sandeep, when it comes to some of these consumer durable names? Because while the earnings have been soft, whether it's Havells, whether it's Voltas or Blue Star, the story or the fundamental structural story of the under-penetration getting over was there. What's your view on consumer durables?
Yeah, so many of these companies have indicated that demand scenario is not as bad, but the sentiments still remain subdued as far as consumers go. And I think that's been the challenge for most of these companies. So I think again, any tax breaks which come for the middle class in the budget could actually give a huge fillip to a vast majority of consumer durable names. And to for them specifically, I think the budget becomes very important. So let's see. I think by next week we'll have a better perspective.
Okay, wait till next week. Lots going to happen between that and now. But Sandeep, good chatting with you as always. We'll let you go on that note. Adani Enterprises numbers. While we wait for some more details, let me get in some closing trade ideas as well. Kunal, what's on your list?
So that'll be about Bharti Airtel. The stock is looking like it's on the verge of a swing breakout about the previous 2 days of swing resistance around the 1630 level. The stock is trading above those levels currently. So it looks attractive for a swing trade of at least 1650 to 1670 range.
Right. Naresh, what about your closing ideas?
So that would be a buy on UPL. The stock has given a breakout out of a 3-month range. Looks interesting for a move towards 600, 620 in the short to medium term.
Okay, point taken. Those are the closing trade ideas. But on that note, we'll slip into a short break. Don't go anywhere. Last 30 minutes of the trading session. Welcome back. You're tuned into Closing Trades on ET now. Well, there's a sharp spike which is underway at the moment. Let's see what's leading this spike at the moment. Is it the banking index? Is it Reliance? Because Reliance has been actually not participating at all. It's Bharti Airtel, which is one of the top contributors today. That stock is up around 2.2%. Reliance is also trying to put its weight behind it, but has been a bit of an underperformer of late. HDFC Bank, M&M, Bajaj Finance, these are names which are the top gainers. Kunal, what's the sense on Reliance and HDFC Bank? I think Airtel, you talked about how you're positive on that.
Yes.
But what's the next level to watch on Airtel and HDFC Bank and Reliance?
So I think Reliance is much more better placed as of now because the stock has tested this 1300 levels three times. I think the last 2-3 months from November, December, I think, and I think the start of the month of Jan, where the stock tested this 1200, 1250 kind of a zone. And the fact that the stock is now showing signs of RSI divergence, I think the risk reward is very, very strongly placed now in favor for Reliance Industries. My sense is that whenever the stock picks up pace or momentum yet again, the first level for the stock is almost at 1330, 1350 levels, which is a decent 100 points on the upside for a stock like Reliance. So I would believe that current levels, the stock which looks very strong in terms of risk reward, the price setup is Reliance Industries out of the two you mentioned.
1253 is where Reliance is currently struggling, but lots of earnings. IndusInd Bank as well is going to come out with its earnings. What is it going to do after what we've seen from Kotak, Axis, HDFC Bank and ICICI Bank? All eyes on this one. So let me take it across to Gaurav and find out exactly that.
Well, yes, IndusInd Bank is definitely going to be in focus because when we look at pre-quarterly updates, we have already seen some kind of weakness. Advances grew at a range of around 12%, which was actually weakest at least in the last 10 quarters, while deposits degrew on a sequential basis. And on back of this, now brokerages are expecting flat growth in net interest income, and the reason being that high-yielding product net interest margins may decline almost by 10 basis points on a sequential basis as per brokerages. And on back of this, when we talk about PPOP, there are two factors which may impact this cost as well. First is cost to income ratio, and second is the fee income, which may remain flat, and as a result PPOP can decline at a rate of around 14 to 15% on a year-on-year basis. On the back of this, when we talk about provisions, we've already seen that bank created contingent provisions of around 500 crore rupees in the last quarter, and even in this quarter provisions are likely to stay elevated, and as a result credit cost is also likely to stay in the range of around 2%, and that is the reason why when we look at profitability, now brokerages are expecting profitability to decline almost by 40 to 45% on a year-on-year basis for the bank. Other than that, let's not forget that there were two major events which happened. First is bank's CFO resigned, and second is that bank sold its MFI portfolio worth more than 1500 crore rupees to asset restructuring company, which contributes around 5% of their total MFI exposure. And on back of this, we will be definitely watching out on how the commentary comes out, how management is confident about the MFI exposure and their asset quality, and also on the back of cost of funds, how their commentary is going to be something which is crucial to watch out for. But all in all, when we talk about numbers, we are expecting some kind of weakness from IndusInd Bank in this quarter.
Okay, that's the take coming in on IndusInd Bank's performance. But Nestle is the other one as well, which is going to come out with its numbers. High product prices is likely to aid the top line growth this time around for them, although high input prices may actually weigh in on the margin. So a bit of a catch-22 situation there. Snehi is here with what her poll is penciling in.
Well, absolutely. So, on an overall basis for Nestle Q3, we're expecting a very flat set, a muted set of numbers this time around. Revenue is expected to come at 4,797 crores compared to 4,600 crores, a mere uptick of 4.3% year on year. EBITDA on the flip side, we're expecting a 0.5% cut on that front at 1,090 crores. Net profit is expected to come in at 734 crores, which is an uptick of 12% on a year-on-year basis. On the flip side, EBITDA margins, once again, we're expecting some pressure here. In fact, a more than 100 bips cut on a year-on-year basis. We're expecting this margin figure to come in at 22.7% compared to 23.8% on a year-on-year basis. Some other key expectations to watch out for will be higher pricing in chocolate, coffee and milk products are expected to aid the top line. However, hyperinflation in coffee and cocoa and higher advertising and promotion spends may also weigh on the margins and keep the margins in check. A volume growth of 2% is expected this time around versus a decline seen in the previous quarter. So that is at least some positivity to watch out for when it comes to Nestle. The beverages segment is expected to do well on the back of strong pricing-led growth in the coffee segment, and the street is expecting that the company may have undertaken a price hike when it comes to coffee. Now, the dairy business is also expected to remain under stress. When you take a look at the domestic versus export numbers, domestic market growth is pegged at 4%, and for the exports, the international market at 5.5%. Some key important factors to watch out for when the numbers come out. Volume growth and demand trends will be important to watch out for. The raw material outlook on cocoa as well as coffee pricing. The company's internal pricing strategy, if they plan on undertaking any hikes, distribution expansion update, and the demand outlook on urban versus rural demand will be some important commentary to watch out for. So watch out for Nestle, but on an overall basis, we're expecting a very muted set of numbers for Q3. Okay, so muted set of numbers coming in for Nestle. We are also waiting for the numbers of Dabur to come by anytime soon. And when we'll be joined by the management, it will be interesting to understand whether there's going to be a bit of a bounce back in the rural demand or not. Actually, as we speak, the numbers are out of Dabur. The profitability has come in at 522 crores. That's the first number that we have on our screen. Do remember that obviously the margin is going to be an important bit to watch out for this time around. Given the fact that the input prices had gone up, our expectation of PAT was around 515 crores. So it's come bang in line with expectation as far as Dabur's profitability goes. But what's the commentary regarding the way forward? Has the momentum picked up for demand? That is the biggest driver for some of these FMCG companies going forward. And that is something that the street will watch out for. I'm just going through the numbers and I have the consolidated figure with me. The revenue from operations have come in at 3,355 in line with expectation. We are working with a number of 3,340 thereabouts. And even if you look at the other internals, it looks like a steady set because the other income has been pretty stable. No exceptional item as such. I'm just going to try and find if there is any commentary at this point of time. No, not really. But looks like the street is liking it. Finally, some respite for some of these FMCG companies with the numbers holding up to the expectation. Naresh, a quick word as far as the stock of Dabur is concerned. Anything on the charts?
So technically, the stock looks interesting once it sustains above the 530 mark. That's been the upper band for the stock for the last 3 months. And once that happens, it can make a recovery towards 560, 570 in the short term.
Point taken. So that's the word coming in. But I think Mayuresh is with us. Let's take it across to him before we get the management on board, because we'll take a minute to decipher the numbers. Mayuresh, what's your sense on FMCG, and if you have any thoughts to share on Dabur?
Afternoon, Anisha. No, I think for the pack as a whole, I think it's expected to be largely muted, both in terms of discretionary spending patterns that you're probably seeing in urban areas, semi-urban areas. some respite that you are seeing in rural India. And that should probably show some element of improvement as we head into Q4 and Q1, primarily based on a good Rabi harvest that we probably got. Some elements in terms of increase in MSP prices as well. And therefore, I think rural should make some sort of a comeback in a gradual way. But urban slowdown might still continue, hampering the overall volume growth. Because of that, I think the kind of value growth that will come through might also be a little bit on the sample side. They're obviously introducing a lot more SKUs with lower prices, specifically in urban and semi-urban areas, to probably counter this. In some cases, reducing grammage as well to probably maintain margins. But you will need accelerated spending coming through on ANPs, which will mean margins could remain range-bound or even soft till we head as we head into Q4 as well. So generally, I think for the space, soft for Dabur in particular, I think numbers bang in line because when you're probably looking at the comparison that has happened not just on a year-on-year basis, but quarter-on-quarter as well across their business divisions. I think it seems to be a steady state at this juncture. We talk about the consumer care business, the food business, or even the other segments, which is a very minuscule part. But at least for the food business and consumer care business, the EBIT performance on both these time zones probably been steady.
Absolutely. Mayuri, stay with us. Lots more to analyze. In fact, since we're on the subject of Dabur's numbers, who better than Ankush Jain, the CFO at Dabur India as well, joining in right now to answer all of these questions. Ankush, hi. Good to have you on the show and good set of numbers actually in line when, all one is talking about a slowdown within the FMCG space. Tell me what's been your observation on how the rural demand is actually panning out and if you could give some color on the kind of volume picture and trajectory as well that you've clocked in.
Yeah. First of all, good afternoon and thanks for having me on the call. And, first of all, overall context, our overall top line is slightly 3.1% growth, which is slightly ahead of the overall estimate which the market was expecting. And profits or operating margins are also similar, 2.1%. And, this is primarily driven by a couple of factors. One, within India, HPC has grown by 5.5%. And international business has grown by overall 9%, driven by MENA, some very good local performances in Egypt, in Turkey, and in Bangladesh. So overall, it's a mixed bag, while healthcare and beverages has been under some pressure, but other business units have pulled it back to a growth which is slightly higher than the market expectation. Coming back to your rural and urban point. We see over last 3 quarters, sequentially, rural is doing better than urban, both for us and for FMCG and overall larger space as well, which to some extent, also augurs well for us because we are high dependent on rural with 45% saliency. And in urban, though there is some pressure because of slight bit of high inflation, both in services and in other food items. But the resurgence of e-com, the quick com, etc., will give us a lot more opportunities, especially in doing premiumization, in driving new innovations, driving new formats. So I think over next 1 year, while it's very early to comment, but let's hope the worst is behind us. But just a bit of caution, while overall inflation is still inching up and expected to be higher in next year than what it was in the current year.
It is inching up, and that's a word of caution, Ankush. But you managed to hold on to your margins much better than street estimates. They were working with 19.5. You've delivered around 20.3. What aided the margins? And going forward, what's the trajectory? Is there a lever available to improve it further?
Yeah, in fact, in this quarter, we did a lot of value creative initiatives. It has been our journey over the last 1 year, which has aided in improved margins, including, cost optimization, pack price architecture. We have been working with some of the leading consultants in driving those initiatives. And we also optimized some bit of our spend, where to play, where to prioritize our resources much better. So a lot of efforts have gone into maintaining them at similar levels despite inflation at an aggregate level for the group at around 5%. Now that's for quarter gone by. But for the future, I think, as I said, I know we have to be a bit cautionary, especially when it's, inflation is inching up in some of the products we consume, and therefore, while we are stepping up our, PPA, price type architecture, reinventing, margin structure or realigning between the alternate channels, and therefore trying to mitigate it. But it will be very early for me to comment about next year. We are in our annual budgeting cycle. We expect to complete it over the next 2 to 3 months, and we're taking the help of a leading, global strategic, consulting advisory firm to carve out a future strategy for us.
I understand that you need to be a bit more cautious, but I want, two pointed questions to you. One, directionally speaking, is margin going to be higher or at least sustainable around here? And secondly, could you say with some degree of confidence that urban demand has bottomed out?
Okay, so I think point number one, in terms of margin, as I said, it's very, very difficult at this point because we are entering into an inflationary cycle. Our intent will be to maintain it, but we have to be very watchful over the next 2 to 3 months. As I said, when we complete our budgeting cycle, loose ends are still being tied up, pricing, etc., along various categories are being worked, the initiatives are being driven. So it's very early, but if you say it'll be inching up in early next year, it'll be difficult. So I say H1 is going to be a little bit of pressure, especially Q1, which is April to March for us. Q2 we have a soft quarter, and thereabout we have to see. But directionally, we have to be slightly cautious given the high inflation we are entering into from now onwards. And your next point was on...
You can say that the urban demand has bottomed out,
Yeah,
and also if you can give a color on the volume growth this quarter.
Yeah, volume growth in the current quarter has been in India around 1%, and which mirrors our overall value growth of 1.5%, while our MRP-led price increases were 3.5%, but because of trade activations and consumer promotions, some of it were given as a pseudo consumer offers, so it went up to 1% overall volume. And in terms of urban, whether it has bottomed out, I think we are very hopeful of this annual budget, which will come on 1st of February, the union budget, and we expect the government should roll out some, definitely some incentives or some boosters, which will not only help rural but also urban. So urban, to a large extent, has bottomed out, but what will drive it in the near future is more quick com, more alternate channels, e-com, etc. And I believe, that's in the long run very good for everyone, because that improves accessibility. You can try new things. People can order anytime, anywhere. It increases broad category consumption, and therefore people like to experiment and innovate, and therefore it will help everybody, to increase the penetration, because most of the category penetration are the least to be among the countries. Yeah.
Right. Well, Ankush, all I can say is that's a consumer speaking, not the CFO of Dabur. But you know what? Just hold on and bear with us. We're going to take a very quick commercial break, but we want to come back to you and, ask more questions. So just stay with us for a short while. Back with closing trades, and we're still in conversation with Ankush Jain, the CFO at Dabur India. Dabur, by the way, the stock has reacted very positively to the inline set of numbers and the commentary. The stock is now sitting at the high point of the day. It's a good 3.5% uptick that you're seeing on the stock right now. But Ankush, thanks for staying with us. What I wanted to talk about also as to how your international businesses are panning out. You did mention as to how markets like Turkey and Bangladesh are looking good. If you could just give us a breakup of, what the volume growth and growth projections thereof are going to be from these markets in particular?
Yeah. So some bit of perspective on the international market. As I said, international market has grown by almost 11.5% in our IBD business, and including SAARC by 9% in INR. But overall, it is 19% in constant currency. So which means the local teams are really doing accelerating and gaining market shares in most of the geographies and categories we operate. The Dubai business, the MENA business has grown by almost 16%, and that has been seen after couple of years, which means there is a lot of traction among most of our brands over there in multiple countries like Dubai, Saudi Arabia, the Middle East, Lower Gulf, etc., and every country. Likewise in Egypt, where we've grown by 55%, backed by almost 11% volume growth as well. However, because of the currency depreciation on a year-on-year basis by 55%, in INR it gets decreased to 2% decline. Having said that, the local currencies are really accelerating the growth in both market shares as well as pricing growth. Hobby, one of our other major markets, has again grown in local currency by 28%, backed by volume growth of 10%. So, we are starting seeing some mid to high single-digit volume growth in some of our critical markets, which is Turkey, Egypt, Middle East, Lower Gulf, even Bangladesh. Despite the political turmoil which we saw in the last couple of quarters, our quarter growth is still 22% in constant currency. Having said that, Nepal got impacted to some extent, but that was only exception at an overall level. So international has started growing good, coupled with both the volume, market share gains, and we are quite optimistic as we enter the new financial year for our international market.
Media headline, Ankush, optimistic about the coming year and international business looking up, and the performance in Bangladesh has been impressive. Thanks so much for staying back and speaking with us on a whole host of subjects, but we're just in the last one and a half minute of the trading session, so I have to get back to addressing the market because it's been volatile in the last one. We saw a sharp dip but a sharp recovery from there as well. Let's see where we are settling in for the day. 23,300 is the level that we are at as far as index is concerned. The Bank Nifty has managed to is up almost 220 points, and the advance decline ratio is pretty much even. A smidge of a favor coming in for the advancing side, but pretty much a balancing act. In terms of the sectors, real estate as a pack was doing quite well today. So an Oberoi Realty, a Phoenix Limited, a Brigade, a Lodha, these were the outperformers. As well as from the pharma pack, Loris Labs was reacting to that US aid news as well as Granules, Cipla, Abbott India. These were some of the names in the green. As far as the red is concerned, IT was clearly the laggard. So Coforge, Emphasis, Persistent, these were your top losers in the trading session. The consumer durable space was seeing a bit of a reaction. So a Voltas, a Blue Star, these were the names in red. And the fact that Whirlpool's MNC is going to perhaps sell some stake in the local company was also a reason for that 20% cut. But with that, out of time on this edition of the show, from the entire team, thanks so much for tuning in.